I just realized my mic was off, Lady D. Yeah, my mic was off. No one heard my funny joke about your new name. They just saw you wave and talk about Lady D. Sorry guys. Yeah, mic back on. Volume is working. We're here. We're live. Stuff happens. This is the Pirate Traders Morning Show. I'm joined by Lady D. She was given that name by a member of the brigade recently, and we're going to run with it.
Yeah.
All right, guys. Well, why don't we jump into some TA real quick and talk about what's happening with the market? I'm sure that's what everyone wants to know. All right. So, we've been talking all week long about the concept of balance and the different ways that the market can balance off momentum, right? When the market gets momentum, which is basically trending in a certain direction, moving from one location to a new location, it can't keep going forever. It can't go straight up. It has to have a way to digest that move to the upside, okay? We describe that digestion as balance, as balancing off the excess. There's two ways to do it. You can pull back with price to backfill gaps and repair weak references and poor references, and then you just put the market on sale so much that it brings in discount shoppers who see it as being on sale, and then the market continues higher. Or you can balance with time, where the market creates a range and it goes sideways inside the range, and then after enough time, it either breaks higher or lower, right? Well, getting even more complex than that, there are multiple different ways that a market can build a range. It used to do very exact what we would call balance areas, where it would kind of pick a high and a low, and it might be horizontal balance. It might just be going, across like this, or it might be a channel, for example, a channel up and to the right going like that, or a channel down where it's kind of bouncing in a range, but slowly pulling back as it does. That's sort of a traditional way the market used to balance most of the time when it was balancing. But from time to time now, it will balance using what we call a pin, which is basically the market picks sort of a magical level. How they pick that level, I do not know. And I cannot know at the beginning when the market first gets pinned. I can't really know whether we're pinned or we're in traditional balance or we're balancing with price or we're balancing with time. There is always sort of an exploration period where we're trying to figure out what is the market doing. But there are some key signs to show us the difference between regular balance and a pin. And this market is doing them like clockwork. Okay. So I've drawn in this morning a balance area high, 56.61, and a balance area low, 55.89. That would be, if this was a regular balance area, that would be the balance. So what are some things that didn't act like a normal balance area? Well, we tested the balance area high, but didn't get all the way to the balance area low on this particular move. Okay. So that's very unusual. Normally, if we got to a balance area high, we'd come back down to a balance area low and go right back up to a balance area high. Same thing again here. The market looked above that balance area high and failed and pulled in. And the next day, the market actually went higher. It went up and it closed near the highs. And it spent most its time and brought in most its volume near the highs. And then reversed right back down the next day, right? It opened and it just sold off to the downside. So this is very unusual behavior for balance. Generally with balance, you're moving from one end to the other, to the other, to the other, not starting to move up, completely reversing again, completely reversing again. That type of thing is more of the behavior of a pin. The other reason that this looks like a market being pinned to me, when a market is pinned, you end up with a lot of references that are stacked right on top of each other, where things are almost perfectly in line. Again, we're doing this with hindsight, which makes it a little bit easier than doing it in real time as it was happening. But just look at opening prices, closing prices, and points of control here. Closing price, opening price, point of control, point of control, point of control, point of control, right? Over and over again, these point of controls are very, very close to one another. Okay? Opening price, closing price, opening price, opening price, closing price, opening price. See that? Again and again, the opening price and the closing price are really near one another from one day to the next, but yet the market makes a big move. Okay? These are all a sign that the market is pinned, that it is artificially being held inside a range for whatever reason. Knowing that, carrying that information forward today, what am I thinking? Well, first off, we are right smack dab on that pin. I would call that pin 56.35. It's never an exact level, but just to give myself a framework to think about it, I call it an exact level, which is 56.35. Okay. And we're opening just 5 points below that if we were to open right now. So that tells me, because it's not regular balance. If it was regular balance, I'd be bearish as hell today, because I'd assume, since we looked above and failed the balance area high yesterday, that's where we're going today, to the balance area low. But because it's pinned, it tells me the market could go either way, up or down. It also tells me once the market makes whatever move it's going to make, so let's say we get above the overnight high, we start to get buying and the market continues higher, it does not have to break out of balance today. It does not even have to test the balance area high. It may test it. It may not. When it gets up there, it may break out. It may not. And same thing to the downside. If we get resistance below the overnight low, we may get to the balance area low. We may not. If we do, we may break out. We may not. And so you're saying to me, well, Charles, that's not helpful. You're telling me the market could go up, it could go down, or it could go sideways today. This is not helping me in my trading. What is the edge? Well, the edge is monitoring what the market is doing while it's doing it. Yesterday, I had opportunities to buy the dip that ended up reversing and making the high, selling the highs that ended up reversing and liquidating back down. Both times, I had the opportunity to get into very profitable trades because I thought of the market as being pinned. Because I said to myself, this is going to be an unusual day where the market is pinned, and all that I need to worry about is how far are we getting from that pin. So this morning, as long as we're inside this area that I have marked as a balance area, I'm going to assume we're still pinned. I'm going to assume that no matter what it does, it's coming back to 56.35. And only when I see evidence contradictory to that, which is buying above the balance area high or selling below the balance area low, will I begin to change my mind. Lady T, what are you thinking?
All right. I want to share my screen and talk a little bit about the NQ, if that's okay.
Yeah, let's go for it. Yeah, I just covered the ES. I totally forgot about the Q. Let's jump into the Q.
Yeah, I want to talk about the Q because there were some really important things to look for yesterday. So as Charles said, we can make the argument for the market going either way today. So let's just talk about arguments for either side. First of all, look at these highs. Okay, I just got the Epic pen. I'm going to see if I can use that today to help people. So this high right here. Oop. This is super, super weak, right? And I bet a lot of people got caught yesterday with that high, thinking that it was going to break out to the upside. And what did it do? Because so many people were probably going long here, thinking that this poor and weak high was going to break to the upside, the market had a huge liquidation all the way down through the rest of the day. So there's another way we can look at this high right here, which is also, we talked about this last week, a trade that I like to take called the retest failure trade. If you were watching very closely, the market was struggling as it got up here. And tempo is something, as a musician and as a trader, that I'm always very careful to watch. And as I was watching tempo, it was really slow up here and it just was struggling. So because of the tempo, I was not about to take a long trade there. And then when I saw on my candlestick chart that this, on the 15-minute candle, this retest closed red, that's your clue. Whatever you do, don't go long. And that's a good time to take a short. And as you can see, a very profitable trade. So talking about today, I think it's really because of the pin, we have a lot of conflicting information. And when we have conflicting information, the best thing to do is sit back during the IB and just really wait for more information, because we can make the argument that down here, there's this gap. There's a teeny bit of the gap left, and you can see this huge volume node down here. I'm sure a lot of traders got trapped thinking this gap was going to fill, and look, it shot the market just way back to the upside. But since we see it struggling here, there is the argument that it could break again to the downside, because at some point it's probably going to need to go fill that gap. Right, Charles?
Yes, that would be my case. So if traders felt like that gap fucked with them, like that gap was very confusing,
it did, I'm sure.
My thought is sometimes the market makes things hard. Sometimes it intentionally tricks you. That's how it takes your money. That's how they create liquidity, is by convincing everyone to short and then reversing the market up and then squeezing all those shorts and then convincing everyone to long and then reversing the market back down. That's how the market does what it does. So I would say if you felt confused about that gap, you should think that gap still needs to be filled. It does still need to be filled,
However,
in my opinion.
As Jim Dalton always teaches, when the market, when what should happens doesn't, is also very important information. So we could look at this, the fact that the market couldn't fill the gap could signal strength, meaning that leaving that gap there means there were more buyers waiting. It wasn't able to fill the gap, and the market has shot up ever since. We've got this poor and weak high, also left over from 827 right here. Same scenario. It looks like around the same level. So this level is really important to watch today up here, because we've got all these weak highs. So we could also make the argument that market's got to go up and fix that first.
Yeah.
And if it does fix that first, then we're looking at a breakout of balance, in which case you always want to go with breakout of balance. As Jim Dalton teaches, excess and balance are the two concepts you need to absolutely know and trust and study the most to be a successful trader. And I believe that. What are your thoughts on that?
Yeah. So this is the thing about these pin markets that make them such a nightmare, because you really could argue it equally in both directions. So let me just pull up my chart real quick for the NQ.
Yeah.
Yeah. So you're absolutely right in the fact that the market had a chance to fill the gap yesterday and it did not. So that's a when what should happens doesn't, right? It should have, that liquidation should have continued momentum lower, and it didn't. And the overnight reversed back up. So that's a case to be bullish. You've also got value higher than the previous day's value. That's a case to be bullish.
And there's a single print left behind. There's single prints.
Well, that's bearish, that single print, because it was to the downside, right?
Right. That was during the liquidation, but.
Yeah. So that one's not in the bull case, but the poor high, like you said, this is an extremely poor high. This was not humans reversing the market at exactly the same level 3 times in a row. They did it in the regular trading hours, they did it in the overnight, and they did it again yesterday. That is definitely computers. And those computers definitely did that on purpose, which is to create the liquidity up there, right? Everyone who's short yesterday has stops above yesterday's high. So they know they've created liquidity for themselves. They know where they can take profit, right? So they liquidate the market, they get back in, they know there's going to be orders that they can get out with their size up there. So all of those are great bullish cases where the market could absolutely continue higher today. But I could also make the case that if this was a look below and fail, if we don't need to come back for this gap, why the late day liquidation? Why the inability to get above the C period high when they came back in the G period? If this was a true look below and fail, right, we should have brought in strong hand buyers that could have blown right through that high. But instead, what happened? The market liquidated and liquidated and liquidated. So this is where things get tricky. Why such a big liquidation? I'm actually glad you pointed this out, because I wasn't looking at the NQ yesterday. I was looking at the ES. Mm-hmm. So I was absolutely expecting a liquidation in the ES because we got to look above and fail the balance area high, right? So let me expand this out. Up in here, H and J period, I was thinking this thing's going to liquidate. They had to look above and fail the balance area high. If they can't keep this momentum going, this thing's going to fall down. I only thought we would come back to like the opening price. I didn't think we'd keep going. And now that I look at the Q, I understand why we kept going, because everyone was long to try to get above that high, right? Everyone was targeting a break of that high. And so they all just got eviscerated intraday. So this is what makes these pinned markets such a nightmare, is that you could make an equal argument of the market going up or down. You could say the when what should happens doesn't is a reason for the market to go up. I could also say the when what should happens doesn't is a reason for the market to go down.
And I think we can also say, because of the pin, there were probably a lot of big hedge funds and people with a lot of money accumulating positions for either scenario, and based on volume and the green candles and the large volume nodes that I see on my chart, plus value being higher, I have a feeling, if anything, this is going to go to the upside before it's going to end up going down. And at some point it's going to have to go fill that gap. But for now, my bet would be it's going to break to the upside. But you're right about the long liquidation at the end of the day. So this is just more important information to discuss the importance of mental toughness and mental clarity, and not to get caught up in feeling like you have to be in a trade. You really need to wait for more information. And especially on Fridays, I like to mention, I really like to be extra careful on Fridays, because nobody wants to go into the weekend after watching the market, 8 hours a day with a loss in your P&L or a red day on Friday. So I always advise, it's best to be even extra careful on Fridays, because you want to enjoy your weekend and you want to have a good P&L at the end of the day, so that you're not thinking about it all weekend and obsessing over what could have gone wrong. And really quickly, I want to share too, we talked about this book last week, if you guys can see it. It's called The New Mental Toughness Training for Sports. And for a lot of our younger traders.
Do you want to just lower your screen share so that you can make yourself bigger on the screen? And then, yeah, if you turn off your screen share, you'll instantly grow in size.
Okay. Is that better? Oh, stop.
Yeah, there you go. Bingo.
There we go.
Now we can see the title of the book.
The new toughness training for sports. It's going to seem like an ancient text to a lot of our youngest traders, because it was written in the 1980s, but it was written by an Olympic sports trainer named James Lear. And it says this groundbreaking book contains all the techniques that James teaches the pros, including methods for overcoming stress and fear, recovering from injuries and shock, and peaking for important competitions. We are athletes as traders. We are competing against the best, most competitive, smartest traders in the world. So this book is highly relevant if you want to always perform well under stress. So I highly recommend you read it, even though it's really old and the text might seem kind of boring, but the concepts in it are great for exactly this kind of situation where you're not exactly sure what's going to happen. So just stay very clear, stay very focused, eliminate all distractions, turn off your phones on a day like today, and just be completely in sync with what's happening in the market. That's my advice.
Yeah. No, I feel the same way. And I'm glad you brought up the volume yesterday during that liquidation. I was pointing it out on the ES. There were single players that got stopped out for like 1,500 contracts at a time. Those are institutions. Those are big players. That's somebody sitting at a trading desk at Goldman that got stopped out yesterday. And so it's funny that you bring up this concept, that we are competing with the best in the world. Everyone is in competition. A lot of traders, they get this mindset that like, it's just the big players versus retail and everyone's out to trick retail. And it's like, no, we are just the cannon fodder of these massive big players who have millions of dollars worth of research that they're working with on a daily basis to give them an edge and an insight. And they have these mathematical frameworks built up to tell them what are the highest probability things to do, what are the best ways to hedge, how to recognize when things are changing. I mean, they just have so much information, but even they are in competition with each other every day. Even they have to deal with mental toughness and handling massive losses and being able to change very quickly when the market's information changes. And so if people out there are getting discouraged and thinking to themselves, man, these markets are so hard to trade, it's fixed to fuck over the little guy. It's fixed to fuck over everyone.
That's for sure.
Like it is, the markets move in a way to not just squeeze the little guy who's trading 3 contracts, but to the guy who's trading 1,500 contracts too.
Oh my
You
gosh,
know?
can you imagine how much capital you would need to trade 1,500 contracts like on the NQ?
Yeah, you would literally
It's
need
like,
to have at least 100 million
yeah.
under your control, at least. So this is somebody with ungodly size who was sitting at his computer just as fucking annoyed when the market liquidated as you were, and he was
Yesterday.
just like, God damn it, you know? And that's trading. And
Yeah.
we are competing with him, and he is competing with us, and we're all in the same game in competition with one another.
So how do you win this game? What is the most important thing you have to study in order to stay in the game? What do you think?
So you nailed it on the head, right? It is all about patience. When you are coming into a day like today, where you can make an equal argument for the market going up or the market going down, like I have no problem with you having a slight bias that you think there's a higher probability that we're going to repair that poor high than that we're going to go fill that gap. I'm fine with that probability. As long as if the market starts to sell off this morning and it gets below that overnight low, you're able to say to yourself, okay, fuck my bias. I'm going to trade short because it's going to go fill that gap. Like the ability to not force your way into a trade now before you know, which it's going to do, and the ability to change your mind very quickly once you get that new information. That's the only trick there is, you know, to consistent success.
Yeah. It's really just to stay, like you said, be like water, my friends.
Yes. My favorite quote.
Yeah, because I've noticed myself, like when it's really choppy and it's in a really tight range, I'm just like, there's got to be like a big trade in here somewhere. And then it goes nowhere the rest of the day. And I'm like, what the hell just happened? And then the next day you see that whoever was accumulating in that tight range, it breaks out one or the other, and people are making just, a buttload of money catching people that were on the wrong side. And it happens every day. So I've gotten caught too many times, especially in the afternoons. I feel like the mornings I'm like so focused and I make a lot of money in the first hour. I like to be done by like 10 or 11 if I can. On days though where that doesn't happen and I have to sit there all afternoon, I find myself, I can feel the tension building up in my body, and then I'm making really bad decisions, or I'm taking trades that aren't exactly in my plan. And that's when it all goes to hell sometimes. So
No, exactly the same thing for me. I call it forcing trades.
yeah,
If I just feel like I want to be in a trade and I just start like, well, maybe it's going to go repair that. Like, and I just start like taking shots, just like
right.
hoping a trade is going to work. Those never work.
Never.
There's one of 2 trades that work well. One is I was wrong. I thought something was happening and suddenly I realized I'm wrong, and I just switch and I just go, okay, we're not breaking higher. We're going to go lower. And I just instantly switch. Those tend to work well. Or the ones that I am just waiting patiently, not even worried about entering a trade. And all of a sudden the market just speaks to me. And it's like, hey, Charles, doesn't it look like we're hammering out a low here? And I'm just like, yeah, I bet if we get cessation right now, the market's going to fucking shoot right back. It's like those trades, they don't feel forced. They're not, I don't feel like, oh my God, I have to get in this trade. I have to do something. It's just like, I should really take advantage of this opportunity.
And you can do that because you're relaxed.
Yeah.
You're relaxed. You're being patient. And I think Jim Dalton calls that letting the trade come to you, right? Like
100%.
Yeah. So that's another concept we can talk about, next week more, and we can show some examples of that. Because that is, for me, that's the key of successful trading, is just staying relaxed, being in the moment, not feeling stressed out that you have to make money, or I have to hit my profit target today, or where's my stop loss. Just like really be in tune with what's happening. And it's really exciting when that happens. You see the trade come to you, and then you're like, wow, I'm so glad I was patient. I didn't waste all my mental capital, in the initial balance period where it's chopping everyone up and taking everyone's money. You really can end the day feeling like you've improved as a trader.
Yeah, and it's not a natural skill. I don't believe anyone can do. I think the market is like a casino. It's designed to make you want to trade. Everything about how it moves and what it does, the way it stays stuck in a tiny, tight little range and then it bursts, 50 fucking points to all of it is designed to make you feel like, fuck, I gotta participate. And being able to manage your own psychology in the moment and say, no, this isn't my setup. I'm not confident yet. I have to see this first. You know, by having that patience, it really pays in the end.
It really does. So,
okay, well, I've got some good news for everyone that's watching this on the public YouTube. I'm going to be doing my live stream this morning on the public channel. We're going to be open to everyone, not just brigade members. Cool. So after this stream is over, switch over and watch that one. Same YouTube channel, same bat time. But real quick, before we close this out, is there any news we should be aware of, Lady D?
Yes, I did. I just have maybe a minute or two of news. The biggest news of the day today was...
you could pop up your screen share if you wanted to.
Yeah, please. It's not letting me. Do you have the...
do I need to give you permission? Yeah, you should be able to.
Okay. I don't know why.
That's all right. If we don't have the screen share, we can just listen
to
you.
Quickly, the big news today was the PCE report, right? So the Producer Consumer Price Index, I think it came out at 2.5%, which was with what was in line with inflation coming down a little bit. So they said that the 2.5% was the lowest level since February of 2021. The core was up, I think, 0.2%, and the year over year, 2.6%. So this was good news for the inflation coming down, and really that was the main thing that happened today at 7:30 when those headlines came out. And I want to remind the traders that if you go to Market Watch, you can use their economic calendar and always write down, you know, those big announcements like FOMC, PPI, core CPI, and make sure you set an alarm so that you're not in a trade at those times, because it can get really volatile and it can really cause some damage to your account. So that's the first thing I do in the morning is check those news announcements, write them down, set my alarms. So happy Friday, everybody. Happy trading. This is Lady D, and we wish you to end the week with a good P&L so you can enjoy your weekends. It's a 3-day weekend too. No trading on Monday.
Oh yeah, thank you for mentioning. Yes, 3-day weekend. Nothing happened on Monday. Enjoy yourselves. Don't force trades today because you know you don't get to trade on Monday. It's going to be. I think both markets are going to be choppy nightmare today. But head on over to the Brigade stream, and we'll see you all there, and we'll go.
All right. See you in a minute.
Thanks a lot. Bye, Dee.